Ladies and gentlemen, good day and welcome to GRP Limited Q2 FY26 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantee of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harsh Gandhi, Managing Director. Thank you, and over to you, sir.
Thank you so much, and a very good afternoon to everyone. Thank you for joining us on GRP Limited's Quarter 2 FY26 and half-year FY26 earnings conference call. Along with me today, I have company CFO Shilpa Mehta and SGA, our Investor Relations Advisors, on the call. We have uploaded our investor presentation on the stock exchanges and the company website, and I hope you had the chance to go through the same. The quarter in discussion, which is Q2 of FY26, commenced amid persistent macroeconomic and industry challenges, marked by global volatility as we are all seeing, pricing pressures on commodities and the impact of US tariffs. Over the last 6 months, the global economy has faced continued headwinds from trade uncertainties and currency fluctuations, with demand recovery remaining uneven, particularly across advanced economies, shaping the overall industrial environment world over. For GRP, this quarter was marked by steady top-line performance despite global volatility and pricing pressure. Total income stood at 1.331 million rupees or 1.33 billion rupees, reflecting a nominal year-on-year growth. However, in the quarter under question, volumes dropped, influenced by geopolitical uncertainties, mostly on account of the US tariff situation, which affected our export business and the overall momentum. Let me elaborate this from an industry perspective. Global tire demand has been mixed, with growth in passenger and light truck markets, mostly in China, India, and other emerging regions, while Europe and North America continued to face pressure from weak domestic demand. Truck and bus OE demand remained subdued, particularly in North America, while Latin America was also affected largely due to Brazil's slowdown and the actions of the US tariffs across Latin America. Europe, on the other hand, saw some recovery during the quarter, and replacement demand remained stable across the regions, but this was mainly supported by import-led growth. Turning to the rubber industry globally, rubber consumption grew close to 2% in the first half of the year, led by some recovery in China and India. But Western markets, however, have dropped by nearly 10%, and other emerging markets, particularly Vietnam, Russia, while reporting strong double-digit growth, they have sort of highlighted a shift in the demand dynamics world over. Virgin rubber prices in this same period on a year-on-year basis, except for butyl, were lower, except for butyl, which rose about 24%. On the reclaimed rubber front, exports to North America region from India during the quarter for the country as a whole declined by around 29%. Back in India, we saw a decline in reclaimed consumption in Q1 or a Q-on-Q basis, while we are starting to now see an uptick in overall consumption on a year-on-year basis. And this is driven primarily by increased consumption of the tire sector in Q1 FY26 vis-a-vis the previous year. In line with the above trend, the overall revenues were maintained for the segment as a 2% decline in reclaimed rubber export revenues was offset by a strong 20% growth in domestic revenues. Sequentially, domestic revenues rose 9% Q-on-Q, supported by a 6% increase in volumes, while export revenues grew by 16%, driven by a 13% recovery in volumes. However, US tariffs led to a 5% of reclaimed rubber volumes being impacted, with revenue from US-linked customers, including those in other regions reliant on the US market. This includes countries like Thailand, where we have seen a 31% decline in the volumes, and that is roughly equal to 6.2 crore quarterly reduction in revenue. This downturn also drove a 36% reduction in margins, which is from these markets of about 3.8 crores. So the numbers for the quarter reflect that 6.2 crore reduction in the revenue and a 3.8 gross margin reduction on account of these present. Consequently, overall export raw material margins contracted 15% year-on-year, tempering our growth momentum for the quarter. In addition, costs in select rubber grades, which had affected our margins earlier, which we kept referring to for 3 quarters, which is butyl, remained elevated. However, our proactive measures, including diversification of sources, selective price increases with a few customers, and continued excellence in automation and operational parameters, including manpower optimization and power cost reduction, it helped contain the impact, leading to an 82 basis point improvement in segmental EBITDA margin despite the lower export volumes. Our non-reclaimed rubber business underperformed significantly, affected by a soft uptake across all the verticals. In the plastic segment, performance was way down % year-on-year decline in virgin polymer prices, polypropylene and polyamide, and heightened competition from low-cost Chinese imports, which exerted pressure on realizations. On a positive note, the increasing sustainability focus among auto OEMs is opening up opportunities, and work is ongoing for approval of recycled nylon 6 compounds with several of the brands directly. Further, the polymer composite and custom die form businesses, which are dependent almost 100% on the US market, were quite significantly affected. While the custom die forms segment continued to record some year-on-year growth, the polymer composite business was adversely affected by the tariffs and strong local competition in the US, making the operations commercially unviable. After evaluating options and implications, the company has decided to discontinue contract manufacturing for this segment, close the related operations of the polymer composite business, and reallocate resources towards higher growth and more sustainable areas. The expected impact going forward is estimated at about 7 crore on a top line annually, with margins of around 10 to 15% at an EBITDA level from that business that will likely get affected as a result of this closure. Our subsidiaries GCSL and GSPL reported combined revenue of 45 million for the quarter, with losses aggregating to about 12 million, as the business is still not reached optimum scale. We are pleased to announce the successful commencement of the pyrolysis operations at Sholapur. This facility now houses one of the largest single-line continuous reactors set up in India, integrated with our existing reclaimed rubber facility. It incorporates a closed-loop energy system that utilizes syngas for clean and efficient heating, and thereby reducing the environmental impact and enhancing energy efficiency. The plant enables the recovery of 3 key material streams: tire pyrolysis oil, char, which will be shortly upgraded to manufacturing recovered carbon black, and steel wire. As part of phase 1A, which is operational, production ramp-up is underway, and we are witnessing a healthy demand increase steadily, albeit, for crumb rubber from bitumen modifier customers. And with the road surfacing season now beginning, volumes are expected to strengthen in the coming quarters. The commissioning of the recovered carbon black unit is expected to be towards March or April of 2026 to further unlock growth opportunities in this space. A total capex of rupees 72 crore has been deployed towards this project, along with an additional 22 crore in the reclaimed rubber business for new technology and maintenance as part of the investment plan which was outlaid, taking deployment to about 95 crores over the course of the last 4 quarters. The balance outlay will be incurred in phases by May or June of 2026, with continued investments directed towards technology upgradation, energy efficiency, and sustainable growth. In conclusion, while short-term challenges, particularly the U.S. tariff situation, have impacted our performance this quarter, we continue to remain confident about our long-term story. The focus continues to be on operational excellence, strategic execution to strengthen our competitive position. We have been affected adversely with the U.S. tariffs, but we are committed to navigating these headwinds with resilience and restoring growth momentum as conditions stabilize globally. With this now, let me hand over to Shilpa to take you through the financial highlights.
Good afternoon, everyone. Let me take consolidated financial highlights for Q2 of FY26. In Q2 of FY26, total income stood at rupees 1331 million as compared to rupees 1319 million in Q2 of FY25, which is up by 1%. Income for the quarter includes accrued APR income of rupees 4.34 crores. Gross profit for Q2 FY26 is at rupees 680 million as compared to rupees 670 million in Q2 of FY25. So it is up by 1%. And gross margin is at 51% for the quarter. Other expenses also include a notional forex loss of rupees 2 crores on account of devaluation of forex of foreign currency, particularly due to fluctuations in currency in Q2. EBITDA for Q2 of FY26 is at rupees 114 million as compared to rupees 100 million in Q2 of FY25, which is up by 13% on year-on-year basis. EBITDA margin in Q2 of FY26 is at 9% as compared to 8% of Q2 of FY25. Profit after tax for Q2 FY26 stood at rupees 20 million as compared to rupees 25 million in Q2 of FY25, which is down by 22% on year-on-year basis. Now we'll come to first half of FY26. In H1 FY26, total income stood at rupees 2578 million as compared to rupees 2586 million in H1 of FY25, remaining flat growth on year-on-year basis. Gross profit for H1 FY26 stood at rupees 1304 million as compared to rupees 1340 million in H1 of FY25, which is down by 3% on year-on-year basis. EBITDA for H1 FY26 is at rupees 222 million as compared to rupees 233 million in H1 of FY25. And EBITDA margin for H1 FY26 is at 9%, which is similar as in H1 of FY25. Higher finance cost was also on account of withdrawal of subvention benefits since Q3 of FY25 and addition of term loan for capex. Of the total interest cost of rupees 6.92 crores for H1 of FY26, 62 lakh pertains to forex loss on the term loan and an interest of 1.45 crores on ECB loan. Profit after tax for H1 FY26 is at rupees 37 million as compared to rupees 69 million in H1 of FY25. On the debt side, our net debt, which includes both long-term and short-term debt, stood at rupees 1788 million in H1 of FY26. Our debt equity ratio is 0.99 in H1 of FY26. With this, I now open the floor for question and answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, We will wait for the moment while the question queue assembles. The first question is from the line of. A reminder to all participants, you may press star and one on a touchtone telephone to ask a question. The first question is from the line of Yash Purve from Innovate Research. Please go ahead.
Hi, sir. Good morning. Good afternoon. So, sir, I'm new to this company, so please excuse me if I ask any question. So, my first question is on the capacity utilization. Could you share on each segment-wise what would be our capacity utilization currently?
Do you have other questions? I would prefer that you.
Okay. So, sir, my second question is on the 250 crore capex that we are doing. So, largely this capex is towards the pyrolysis and crumb rubber only. So, is there any capex of this? How much capex would be towards the reclaimed rubber and other non-reclaimed rubber? And post this capex in those segments, what would be the capacity post this capex? And my third question would be, our crumb rubber plant was started in Q4 last year, and we haven't generated any incremental revenue, I guess, from that plant. So is that plant only for pyrolysis, or we will be selling that crumb rubber out of that also? So yeah, those were my questions.
Okay. I will address each of those one by one. As far as the capacity utilization is concerned, as for the reclaimed rubber, we are operating more or less at about 85 to 90% utilization of capacity. As far as the non-reclaimed rubber businesses are concerned, we are operating at about 40% utilization only. So that's to address that particular question. And this includes, obviously, combination of the composite business, as I mentioned, more or less in Q2, we have pretty much blanked out production. Very little production was done on account of the tariffs. Same was the situation with the custom diaphragms, and the nylon business has also gone through a set of challenges on account of the price pressure. So capacity utilization in the non-reclaimed rubber, as I mentioned, was closer to 40%. Your next question was regarding the capacity expansion and the outlay of the 250 crores. As far as the outlay of 250 crores is concerned, that was to be spent across combination of pyrolysis, recovered carbon black, and reclaimed rubber, all three. And when it comes to pyrolysis and recovered carbon black was to be the bulk of the spend at roughly, I think about 60 to 65% of the total spend is to be on the pyrolysis and recovered carbon black, and the remaining was to be between reclaim and also some amount on the plastic recycling. So that's to answer your question as far as the capex plans are concerned. On the crumb rubber volume and revenue, yes, we have started the crumb rubber plant before, but a large part of the capacity is dedicated to or allocated to the tire pyrolysis business. As far as the income from the this business is concerned, it is in the region of about 20 crores for the half year is coming from, one second, this is, yeah, H1?
H1.
Yeah.
47.
Okay. And sir, in just a follow-up question, in H2 combined of pyrolysis and crumb, how much revenue could we expect from these capacities?
I'm sorry, come back again.
Sir, in H2, how much revenue can we expect from crumb rubber and pyrolysis?
Now that the pyrolysis business has established, I mean, the reactors have begun, there's an expectation that this, as far as H2 is concerned, would generate anywhere around the 25 to 30 crore revenue for the second half. And this would include combination of crumb as well as pyrolysis, oil and steel all put together.
Okay, sir. Thank you.
Thank you. A reminder to all participants, you may press star and one to ask a question on your touchtone telephone. The next question is from the line of Ajay Surya from Niveshaay. Please go ahead.
Hello. Am I audible?
Yes, please go ahead.
Yeah.
Thanks for the opportunity. So my question is majorly, I wanted to know a little bit more about how is the industry demand scenario and the business scenario, business environment changing up recently, because maybe from all the past conversation we've had and with the EPR policy coming in, there was a lot of traction for maybe tire recycling to go ahead with maybe a larger adoption of reclaimed rubber and the other products which maybe we can get out of tire recycling. Wanted to understand, like, what are the difficulties that maybe we are going through, or maybe if you can share some insights on how is the industry currently shaping up. Is it more of maybe a lot of industry consolidation that is happening, or maybe a scenario of overcapacity which is maybe impacting our performance? Or maybe any sort of that insight which maybe we can help us understand the business for a longer perspective. So that is one question which maybe you can, answer in detail. That would be really helpful. Second one is on, again, because congratulations for our new plant which has started for crumb rubber and pyrolysis. Congratulations on that part. But wanted to understand, like, because we are developing our own sort of technology for the recovered carbon black, and maybe from the past conversation which I can maybe get, we expected this to maybe come in by this year's end. So wanted to know first thing on that part, like how are things on track for that, and how are we looking at recovered carbon black as an overall mix once we expect this plant to maybe come in and ramp up in maybe 1-2 years timeline for overall business for the recovered carbon black plant. And third last one, because out of the phase 1 capex of 150 crore which we planned, I guess roughly 70-75 crores have been spent. Wanted to know and get maybe some clarification that the remaining would be just for the recovered carbon black, or we have some more crumb rubber or maybe pyrolysis for which maybe we will put some money, and the remaining 100 crore capex for phase 2. Would that still remain intact? Would we delay that? Would we first want to maybe get some utilization of this existing 150 crore capex, then plan to deploy in maybe the categories where we maybe see better opportunities, better ROE, ROCs? Would that be dependent on that, or our existing plans of maybe putting that 100 crore still remain on the same plan which we had maybe a year ago? If you can maybe clarify that. That's it from my side.
Thank you so much for the detailed set of questions. I will answer the capex part of your questions first and start from there, and then go to the subsequent questions on the outlook for RR, and also as a result of the answer on capex, I'll also provide some perspective on the RCB outlook that you talked about. So just to clarify, out of the 150 crores, what we mentioned is 72 odd crores has been spent on the what we are calling the green energy business, which is a combination of the crumb rubber, pyrolysis, and the recovered carbon black. All of these three will be in a single location, and therefore part of that project, 72 crores has been invested. The remaining 22 has been invested in reclaimed rubber technology upgradation and capacity augmentation there. So that's the total spend as of today. And of the 150, the remaining 56 will be spent.
47 ordered. 48.
Hello.
Sorry to interrupt, Ajay.
Yeah.
Hello.
Sorry. So the remaining 56 crores is to be spent, was to be spent by December 25. But as I mentioned, on account of the initial delays in the project, we are looking at deploying that over the course of the next 6 to 7 months. So therefore, by May, June of 2026, this funds will get deployed, and that will complete phase one, which is the 150 crore capex, which will provide us capacity of pyrolysis for 30,000 tons, 12,000 tons of recovered carbon black, and crumb rubber capacity, which will be closer to 60 KT or 60,000 tons. So that's the entire phase one. Post that, initial plan was to immediately start deployment in phase two for the balance 100 crores. We have the funds available, as you know, from the fundraise that was done through the DFI, but the exact deployment plan of the same is still not completely finalized. We do have the land permission and approvals for consents in the Dahej that we're starting to go out and seek. And once those approvals come in place, we will kind of put in place the phase two deployment plan as far as the remaining 100 crores is concerned. But we remain committed to deploying that as well, and that will create additionally the 30,000 tons plus 12,000 tons of RCB as capacity. Crumb rubber capacity may not be as large because we already have capacity in Gujarat plants, which may offer some material directly there. So that's why the outlay there may be a little lower than what we are intending to spend in the current phase one. Also, we have the land and some amount of development done in Dahej, and as a result, that investment is lower than the first phase investment. As far as recovered carbon black itself is concerned, there's been quite a bit of progress, including announcements by carbon black companies both in India as well as internationally, and also a lot more approvals are in place, and tire companies have started to use some amount of recovered carbon black in India as well as in other parts of the world. So we do remain optimistic and bullish that the offtakes will start. However, it takes time for adoption. As we said, tire companies will have its own approval cycles for adoption. But as part of our current phase one, we already have a pilot facility in place where we are producing small quantities of the recovered carbon black and are offering for approvals to the non-tire sector, which includes customers in the conveyor belt and sheeting applications, roofing applications. So we are already building that traction such that by the time our carbon black facility is up and operational, a pilot facility can provide customers the confidence of the quality that is coming in. So that's to provide the perspective on recovered carbon black. The third part we talked about is the outlook of the reclaimed rubber itself, and I will divide this into three parts in terms of geographies. I would say India, US and Europe, and then the rest of the world. As I already alluded to in my comments as part of the opening remarks, India, we have seen reclaimed rubber demand actually grow. Tire companies in India have started to use more reclaim than they used to in the past, and this is again available public data and information. And as a result, our sales, sales to the domestic tire and non-tire companies, as far as reclaimed rubber is concerned, has increased. We remain confident that this kind of will continue to grow rapidly over the course of the next few years, as more and more projects and more tire companies are continuously working on increasing this percentage. We are also actually seeing on the other side that there are tire companies and non-tire companies that are also focused on reclaimed rubber as an economy product like they have in the past, and therefore demand for certain other type of grades which are lower cost or produced from alternate materials is also growing, and we are kind of actively offering such material as well. So that spectrum of product preference is growing compared to what it used to be, and that's a good sign. As far as EU and US is concerned, I think the demand drop has been very, very sizable, both partly on account of tariffs, but partly on account of the economic downturns in these two geographies. And therefore, our exports to those markets has taken a major beating, as I mentioned in the comments. And that is one of the reasons why, while we do have the capacity and while we do have the approval, the volume offtake has not been at the same pace as what we would have liked. The third set of markets is the rest of the world, with China being leading it, and then others like Vietnam, Thailand, Latin America, etc., also contributing to consumption of reclaimed rubber. In these markets, it's been a mixed bag. As I mentioned, countries that were dependent on the US have had a reduction in demand for reclaimed rubber, case in point being Brazil, Thailand, etc. While others, which were like the likes of Vietnam, Philippines, Indonesia, there the demand has grown. But by and large, rest of the world, as far as reclaimed consumption is concerned, as a result, has been nominal single-digit growth. But India has been the bright spot when it comes to reclaimed rubber because there the consumption continues to grow. So I hope this answers all the three parts of your questions on the outlook, on the perspective of recovered carbon black, and also on our capex plans.
Yes, thanks for the detailing answer. Can I chip in more questions?
Could you come back in the queue, Ajay? Given
Sure, sir.
We've had a fair bit of time taken for your questions. Thank you.
Yeah, thank you.
Thank you. The next question is from the line of Divya Agarwal from FinCom Family Office. Please go ahead.
Yeah, hi sir. Thanks for taking my question. My first question is on the new pyrolysis plant. So you said the crumb rubber that we sold in H1 was around 20 crores. So just wanted to know about the realizations and the margins, and even the realizations and the margins for pyrolysis as well as the RCB that we would be selling in H2. My second question is on the non-RR capex. So to answer the previous participant question, you said the non-RR capex should be in the domain of plastic vertical. So just wanted to know if it's only related to plastic vertical or other segments as well. Next, sir, I just wanted to know about our subsidiaries, GSPL and GCSL. So, I mean, the revenues have declined quarter on quarter, and the losses have been stagnant to around 12 million. So, just wanted to know what's the problem there and when can we expect it to turn around. And lastly, on the plastic vertical front, So, why the demand is being subdued despite the EPR mandate coming in? So, yeah, that were my set of questions.
Thank you. So again, I'll answer your part of questions around the plastics first. As far as the plastics is concerned, polypropylene or polyolefins, there the price has been significantly affected. I think there's been almost a 30-35% drop in the virgin polypropylene prices. And as a result, the demand for recycled plastics has been quite badly affected. Although the EPR is in place, we are not seeing the same traction in terms of enforceability and implementation of EPR in the plastic packaging sector as we've seen in the tire sector. So that's one of the reasons why the economics are not allowing for increased usage of recycled plastics at the moment. I mean, wherever it's being used as an economy or a price or a cost saver, customers continue to be focused on taking it off. I mean, that these are the larger brands, but wherever they're more driven by cost, those markets or those set of customers have kind of shied away from, or expectations of price are such that there are pretty much zero or no margins to make on those kind of sales. So that's one of the reasons why the sector has been affected. And that in some ways is what GCSL and GSPL, the subsidiaries, are actually doing is the plastic or the polypropylene recycling, and that's the reason for that being low. As far as the crumb rubber is concerned, I would like to sort of stand corrected. As far as crumb sales is concerned, it is a combination of sales from that plant to what we sell internally within the GRP facilities as well as what is sold outside. So the total number of 20 crores is actually reflecting overall sales from that unit, but not all of it is going to external sales. I don't have the numbers off the cuff at the moment available, but we'd be happy to connect with our IR team to provide a breakup of the crumb rubber sales numbers both to the different sectors. But to provide you a perspective, the crumb rubbers that we are selling to the crumb rubber bitumen modifiers as well as to the rubber industry. And the rubber industry is essentially manufacturers of mats, sheeting, and so on, which are also buying crumb rubber of certain size for use as a replacement to the virgin rubber. The bitumen modifiers obviously are the demand was obviously subdued in the monsoons, and as a result, road construction comes to a standstill more or less in the country, and as a result, sales to that sector in Q2 was not as promising, although we did make several volume sales as far as Q1 is concerned. But we have approvals, and now that the tenders are in place and the road construction activity likely to commence from end November, December, our order books are starting to fill up, and whatever is the surplus capacity of crumb that we currently have for the mesh or the size that is required by the bitumen modifiers, we are expecting that by January, February, we would be pretty much operating at healthy utilizations of over 75-80%. So that's as far as the crumb rubber business in itself is concerned. As I said, I'll share some more details subsequently in terms of sales to the different segments and realizations across the different segments. As far as steel is concerned, again, like all basic commodities as steel, cement, and other commodity prices have been a little firm, and the demand is kind of growing on account of the infrastructure spent by the Indian government. The demand for the steel that we are generating from our crumbing plant continues to be steady, and we have customers in the region within a 100-150 kilometer radius, combination of mills as well. So mills that are producing it either for construction quality cement and or other quality steel, and they are all customers of the steel that we are supplying. So that demand is picking up steadily. I think at the moment we have pretty much no inventory of the steel available. Everything is being sold off and is at reasonably attractive prices as well. Hope that answers all your questions.
Yeah, sir. On the non-RR CapEx front, is it only related to the plastic vertical or other verticals as well?
Sorry, what part of the CapEx for
non-RR CapEx. So, previously you had said that the non-RR CapEx would include CapEx for plastic vertical. So just wanted to know if it is only related to only plastic vertical or other non-RR segments as well.
No, so non-RR in our case is mostly all plastics. It's either of the nylon, which is the polyamide or the engineering plastics, or the GCSL or the subsidiary, which is the polyolefin plastics. Composite was another non-RR activity, which, as I mentioned, we have taken a call to shut down. So therefore, there won't be any new investments in there. The investments in both the nylon and the polyolefin businesses will be determined by the increase in the utilization of capacity. As I mentioned, currently we are operating at 40% utilization. So only once it gets to a certain healthy level of utilization, we will take on the next phase of growth or expansion in there. But that outlay is not part of this outlay that I already mentioned of this 250.
Sure, I got that. I'll get back on the queue. Thanks.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask a question on your touchtone phone. The next question is from the line of Pranav Bohra from Manish and Mundada Associates. Please go ahead.
Hello, sir. Good afternoon. Hello.
Yes, please go ahead. Yes, please go ahead.
Okay. Sir, as you stated that due to US tariffs, there is a decline in our margin, right? So is that only the factor in decline of margin, or there are any other factors in decline of margin?
I think I've indicated there is a bunch of reasons for the margin decline. One is the US alone. There has been a decline in margin, which is roughly 3.8 crores at a gross margin level. Over and above that, the recovered carbon black business, there has been not recovered carbon black, but the RC business, which we have pretty much had very little sales through Q2, that generates a certain EBITDA, which has obviously been affected in the quarter. Shilpa did mention that there is, or our numbers include a notional forex loss of about 2 crore on account of revaluation due to currency fluctuations. So that's another impact as far as the margins are concerned. And the additional interest costs on account of both withdrawal of subvention as well as the new loans that are taken is the additional factors. So these are all the one-offs, if I may, that affected the quarter. And I think it's adequately explained in the investor presentation as well.
Oh, okay, sir. So, when can we restore it, sir, again?
I think the US and Europe business, we are trying hard to sort of get other geographies to sort of make up for this in terms of both volumes and margins. India, as I said, the growth is quite significant, so large part of the volume will get made up for with domestic demand and demand from other emerging markets, but margins may not get entirely restored because US and Europe continue to be the high margin markets for the company. Of course, the rubber composite business, since we are shutting, is not going to kind of revive. And as I mentioned, that's an impact of 7 crore annual top line with about 12-15% EBITDA. So that's currently lost for now. We will explore what else we can do with that infrastructure and see how we can sort of make up for that in subsequent periods. So that's in a nutshell. Some other margin changes that may come about is, and I think in the previous quarter we have announced plans of investments in solar energy, which will lead to significant energy cost savings for the company in Sholapur. And similarly, investments are being planned for investments in alternate energy or renewable energy for the Gujarat plants. This is both in line with our long-term agenda of getting 50% of our power through renewable sources, and we are on track to achieve that by middle of next year. But that will also be accompanied with impact on the bottom line by way of the unit cost changes. Our new technology for reclaimed rubber is starting to pick up, and there is sizable traction on those set of products, and we are seeing as a result an additional or an incremental margin accruing on account of those product sales. And there the utilization is improving quarter after quarter. So I think at some point, I would say by the end of the year or rather beginning of next fiscal year, the full impact of the new technology and its impact on margins will start to also showcase. And that therefore will reflect in the overall FY27 numbers. Part of it in FY26, but entirely in FY27.
Okay, sir. I'll come back with you, sir.
Thank you. The next question is from the line of Kunal Shah from Anova Capital. Please go ahead.
Hi. After the planned exit from polymer composites, our non-reclaimed business saw 17% decline YOY. So how quickly do we expect the stabilization?
So I mean, if you're exiting a business, it's that revenue is pretty much lost forever. We will only have to wait to see what other businesses, and as I said, how we reutilize that capacity or that infrastructure. We haven't finalized or decided yet, so therefore that gap will take some time. But as I mentioned, the new capacity of the new technology in Ara is starting to pick up pace, and we are seeing that utilization as it improves will start to add to the revenue with the reclaimed rubber business itself. And of course, the addition of revenue by way of crumb rubber, steel, and TPO, that's all beginning in this quarter. So starting Q3, the revenue growth, margin growth will start to be observed consistently.
Okay. And can you tell me the peak revenue we achieved from polymer composite?
I think the peak revenue we've achieved was about 12 crores. The last 12 months or 15 months, the run rate was at the rate of 7 crores annual. But the peak we have achieved at some point was about 12 crores. This was about 2 to 2.5 years ago. Yeah.
Okay. And in engineering plastics, we have seen some volatility, and virgin nylon 6 prices are also down. So any flavor on how our margins are being protected in this volatility?
So good thing is that our margins continue to be driven partly by the fact that, as far as nylon is concerned, we continue to rely on raw material which is in-house generated from end-of-life tire material. And to that extent, therefore, the margin has been more in our control than before. But of course, since virgin nylon prices have dropped, our selling prices in those categories have dropped, and as a result, the margin has been affected. I think we used to be in mid-teen EBITDAs. Currently, we are operating at just about 10% EBITDA as far as that business is concerned. So there has been a drop, and I think you mentioned and hinted already that there will be some impact on account of the softening of virgin nylon prices itself. I think there will also be a pretty significant impact, and this is, nylon is not part of that, but under the revised policy of the government, some of the raw materials have been opened up for not going through the BIS approval, and as a result, there is likely to be a further reduction in certain polyolefin materials which are mostly manufactured in China. So we are likely to see a further erosion in margins or further softening of prices when it comes to certain other virgin plastic materials on account of the announcement made by the government just yesterday. That quantification is not available before you ask me that question, but since it's a very recent development, I just want to lay it out there that it will have some impact on overall prices of polymers, and therefore on our margins also there will be some pressure. But this is polyolefins, not necessarily nylon, because nylon this is not applicable.
That's it. Thank you.
Thank you. The next question is from the line of Divya Agarwal from Fincom Family Office. Please go ahead.
Yeah, hi sir. Thanks for the follow-up. So just one question. So how can we expect the H2 to fare? Like, should it be much better or should it be in line of H1 of FY26?
No, I think H2 is obviously, so I'll just lay it out there in terms of how we're seeing it. As far as Reclaim is concerned, I think the worst is behind us. I mean, whatever adjustments we had to make on the business in the US, we've made. As I said, volumes are back. Margins may not be 100% back. But we've taken corrective actions to address the margin decline in butyl, and there our new prices with customers will be effective January. So therefore Q4 we are seeing that the impact of the price rise that we've seen on the raw materials in the current year will get offset from Q4. Volumes are kind of coming back, so we are seeing that as a very strong positive. In fact, on account of the new technology and the power savings because of moving to the solar power will all be available for H2 as far as the Reclaim Rubber business is concerned. So therefore, fairly confident that H2 as far as RR is concerned will be much stronger than what we have seen in the current first half. In addition to that, our plant for pyrolysis, crumb as well as steel is operational and now starting to crank up at a higher utilization. So at the moment, obviously, it is burning cash, but starting next month, we are fairly hopeful that we will turn around and that will be in the black. So for 4 months, that business is going to contribute both healthy bottom lines as well as sizable top line, as I have mentioned. As far as the engineering plastic business is concerned, I would say it will maintain status quo and be similar to the half year because there is still no major changes as far as the virgin nylon prices are concerned. Globally, they continue to remain soft and demand has been affected. However, since a large part of our demand in the engineering plastic business is automotive linked and given the GST benefits that the government has announced and as a result of which the demand in the automotive sectors is coming back, we are fairly hopeful that as far as the engineering plastic business is concerned, demand will start to go back to previous levels. While I can't comment directly on the margins because very little is known about the price fluctuations and volatility over the course of the next few quarters. Last is the other businesses, which is the subsidiary, which is GCSL. As I mentioned, there we see that the softening of the virgin prices on account of the recent import policy will put further pressure on the both the volume as well as the margin of that particular subsidiary. So there we are not expecting a major turnaround for the rest of the year. And the composite business I've already mentioned, we're closing down, so that will obviously not have anything positive to write home about. But net-net, given that Reclaim continues to have much larger capacity and the new capacity of Crumb and Steel are also much larger than what we have in the non-tire or the non-Reclaim side, I think overall the overhang of the tire recycling will definitely be far more positive, and therefore H2 will be far more positive than H1 has been.
Right. So on the margins front, of 300 or 400 basis points improvement, can we expect for H2?
I mean, we've not commented usually, but I'd say at an EBITDA level, one can say anywhere between 200 to 250 basis points would be a fair assumption to make as far as the margins are concerned.
Sure. That was helpful, sir. Thanks a lot.
Thank you. That was the last question for today's conference. I would now like to hand the conference over to management for the closing comments. Over to you, sir.
Again, thank you all for the insightful questions that you have raised. As I mentioned, always I enjoy this discussion to understand how each of the investors is looking at this sector and the company in particular. We have been obviously quite badly affected by the tariffs, as I have highlighted. Don't need to reiterate it, but just want to provide the confidence to all of you that we continue to remain committed towards the investments. And we're starting to see the slivers of hope emerging with the investments that have been made over the last few quarters, and I think the outcome of that is starting to show. So I would say with that, H2 definitely much better than H1, but leading us into FY27, where the full-blown impact of even the recovered carbon black will come through, and we are fairly positive that FY27 will be that turnaround where there will be a significant breakout in both revenue as well as profitability. But with that, thank you all for joining the call and look forward to the next one in another 3 months.
On behalf of GRP Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.